You probably don't know the real cost of free brokers, and if you want to know what you're really paying, you have to look at the broker's business model. As someone who's been trading for over 10 years, I'm going to lay out the real problems with zero commission brokers. What's more, I'm going to tell you which brokers might be a better fit for you. These are the things free brokers don't want you to know. Number one is gamification. Free broker apps like Robinhood and eToro are very good at making trading one of the most difficult skills you can learn feel like a video game. Game mechanics make it easier to draw in new users and keep them hooked. eToro flashes a leaderboard in your face to provoke competition between traders. The entire marketing strategy of these apps, in a nutshell, is ease of access and reduced friction. It's never been easier to start and to keep trading. And at every step of the way, you're getting this illusion of progress with constant motion and infinite levels. But that's the thing, it's all an illusion. You're not progressing. You're not getting better. You look at your account and realize apps like Robinhood take advantage of your brain's tendency to look for the path of least resistance. It's why you chose Robinhood in the first place. Look at its interface. You can make trades without even knowing how to trade. Sure, Robinhood has some rudimentary tools, but they're designed to be ignored. They use simplicity to hide the tools you need to make informed decisions, probability analysis, or combining Greeks across different legs. If you want to set realistic targets and quantify expected value, these are important metrics you have to look at before you click confirm on your trades. So why doesn't Robinhood just fix that? Why doesn't it put in-depth analysis into the flow of user experience? Well, because of their business model. Reducing friction means making trading as easy as possible. They don't make money based on the quality of your trades, they make their money on the quantity. The more trades you do, the greater the illusion of control, the more confident you feel, the longer you stay on their app, and the riskier your trades become. And gamification keeps you in that loop. And not only does gamification encourage you to take bigger risks and therefore bigger losses, you end up making trades you otherwise wouldn't make. Like with a lot of apps, a team of researchers, engineers, and consultants have been paid a lot of money to design the app to do two things to you. One is to reduce the time you spend between thoughts and actions, and two, to condition a reward response each time you act. This is the real reduced friction, and it's friction you actually need in order to get better at trading. Without any pause points or speed bumps, you don't reflect on your positions and risk. Making a beneficial long-term strategy is a constant uphill battle against an app that is designed to make you do the exact opposite. What you have to realize is that the right broker doesn't make trading easier, they make trading better. When you're looking at potential brokers, ask yourself the following. Is the user interface sacrificing clarity for simplicity? Check if you have easy access to all the tools you need to make deliberate, informed decisions. And if your broker sends alerts or push notifications, check their language. Do they actually seem informative, or are they triggering feelings of scarcity and urgency? When it comes to the bells and whistles of your broker, ask yourself this: who benefits more from these design decisions, me or the broker? So if that's how free brokers like Robinhood and eToro are designed, how do they make money off of us? Well, number two, payment for order flow. Without commissions, so-called free brokers make their money through something called payment for order flow, or PFOF. When you order a trade, instead of sending it straight to the stock market, Robinhood routes your order to a middleman called a market maker or a wholesaler. They're usually big firms like Citadel or Virtu who pay Robinhood fractions of a penny for each share so they can execute your trade for you. And if Robinhood is the dealer at the card table, market makers are the bookies who pay the dealer for exclusive access to process player bets. Let's say you go on Robinhood and buy one share of GameStop at a bid price of $23 and an ask price at $23.05. Therefore, the bid-ask spread is 5 cents. The spread represents the implicit cost for a trade. Essentially, it's the price to play. But the market maker gives you something called a price improvement. They use their huge inventory to immediately give you their own share of GameStop at, say, $23.03 instead of the full $23.05 ask price. Now, you keep those 2 cents of improvement, and the market maker pockets the remaining 3 cents of the spread as their profit. You might be thinking, so I don't have to pay Robinhood any commission and I get a price improvement in my bid-ask spread? Well, ask yourself, why are market makers handling retail trades in the first place? They know retail traders don't usually have the funds, the tech, and the insider info to change prices that much. When they instantly buy a replacement share of GameStop, they hedge their short-term risk. They've effectively made a guaranteed profit on the bid-ask spread without ever worrying about the stock's price changing between your order and their own counter trade. And as you could guess, apps like Robinhood can choose the middleman who pay them the most, which could mean a worse price improvement for you. Sure, under the law of best execution, execution, brokers have to try to get you the best price for your orders. But how do you know that's what you're getting? In fact, in 2020, the SEC made Robinhood pay $65 million for failing to uphold their duty of best execution. And even now, you don't see how your individual orders were routed. So how do you know you couldn't get a better price from a different middleman? You can go on their website and check their quarterly SEC Rule 606 report so you can see where your orders are routed. Also, when you're trading, compare your execution price to the NBBO, the National Best Bid and Offer. It tells you the best bid and ask prices for securities across all US exchanges. Now, tokenization is sold the same way, which brings us to number 3. Tokenization, in simple terms, creates digital tokens on a blockchain network to trade and represent ownership of real-world assets. For Robinhood, the goal is, you guessed it, reducing friction and making things more tradable. Not only stocks and bonds and commodities, but also land, real estate, art, and even private companies where you need to be an accredited investor to buy and sell equity. With fractional ownership and 24/7 access to markets, Robinhood is, again, acting like they're giving you free access to an exclusive club. But you know there's a catch. Higher access means higher risks, because tokenization has lower liquidity, which makes it harder for you to determine what a fair price is. When there aren't enough buyers and sellers, the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask, widens. When the fair price is somewhere in the middle of that bid-ask spread, a single trade can swing prices way beyond what a fair price would actually be. That high volatility creates slippage, where the difference between the expected price and the actual execution price can be massive. That's what makes it hard for a retail trader to find a reliable market price. Also, unlike most retail traders, big firms have the higher liquidity and inventory to move markets. They have the high-speed tech to inch out competition by the millisecond, and they have the superior analytics, targeted research, and social connections to see the true value of these real-world assets. If there's a change in the market, they are going to know before you do. I can't recommend this kind of trading. These are a liquid, highly volatile environment. If you decide to try anyway, you should only trade with what you can afford to lose permanently. When you have a broker with this kind of business model, the greatest edge you can have is self-control. So, with all of these potential risks and pitfalls, how do you actually choose the right broker? If you have to use a commission-free mobile app, Webull might be the best fit. It suffers from the limited tool problems most mobile brokers have, but its interface is much more professional and gives you better access to the tools and data you need. Sure, it may have a higher learning curve, but that's for your benefit. Charles Schwab has a different business model from Robinhood, and this makes for a much better trading experience. So with Schwab and its platform Thinkorswim, the interface gives you probability analysis, Greeks, multi-legs, and a whole lot more. You're getting better tools and a straightforward fee per contract, making the overall cost potentially lower on large and more complex trades. That way, instead of squeezing as much as they can from your trades, they're getting you the best price improvement, and they're much more transparent about their best execution disclosures and quality metrics. Regardless of the broker you do choose, you do have to understand that in business, nothing is free. The cost is just hidden. And when you don't know who's really paying, someone else might be the user, and that means you are the product. Subscribe if you want to keep getting these kinds of insights from experts like us. Otherwise, I'll see you in the next video.